Hello and welcome. This is my take on this. My name is Martin, and today we're watching a video from Reventure Consulting about the US housing market.
In this video, I'm going to tell you guys about the next city on the US housing market that I think is going to crash. But first, I want to talk about some concerning data we are seeing from real estate investors in America.
I just stopped it right there real quick because this kind of looks like Florida. I used to live in Florida for about 8 years. So it will be interesting to see actually where he is, what he's talking about.
America. These investors, they are bailing hard on the US housing market, especially in states like Florida. According to Axios, institutional investors are buying fewer homes in Florida, while data from Redfin shows that in certain cities, investor purchases are down as much as 60%. I believe that this investor exodus from the housing market could be making the housing downturn worse and could push home prices down further if you live in a city and area that has a lot of real estate investors. Because what we're seeing right now closely mirrors what happened in the mid-2000s, right before that last massive housing crash. Back in the mid-2000s, in 2005, 2006, that was the last time investor purchases peaked, and then investors started bailing on the market back then about 2 years before prices really started going down. You can see a very similar trend today, and I'm finding investor homes on the market all across Florida, and in some cases they're selling at pretty big discounts. Because the beauty actually of when investors sell on the housing market, everyone, is that they will often sell pretty quickly at a price to move the house.
So yeah, there's always a lot of investors in Florida. And I personally think there should be some rules, meaning, for example, if you buy a house just for the purpose of making money out of it to sell at a higher price, there should be something like, if you sell it in a year, you pay 20%, 2 years, 15, and so on. Only if you really keep the house for at least like 5-6 years, you should be okay to sell it without any penalties, let's say. And I know that's just me, and I'm sure a lot of people don't agree with what I'm saying, but we shouldn't really make profit out of people's necessity to have a roof over their head. It's different if they just buy it and rent it out for a reasonable price. That's fine. But just buying it in the hopes to sell it like in 2-3 years to make a big profit, that's just not how it should be. And that's usually why prices are going up that fast. And that's what happened in 2006, 2008, when prices just went crazy.
They're usually more open to cutting prices than regular homeowners, and so you might have more room for negotiation if you buy from an investor. And this Axios article was really interesting, everyone, because it highlighted how Florida is seeing a decline in institutional investor home purchases. In the first quarter of 2025, only 5.8% of home purchases in Florida were by an institutional investor. Now, in this article, they define institutional investor as an entity that buys more than 10 homes in a year. So that covers the big Wall Street investors. It also covers some of the smaller investors. And Florida's percentage of 5.8% was actually lower than the US rate of 6.3%. So not only have investors pulled back from Florida, they're now buying in Florida, at a lower rate than they're buying in markets like West Virginia and Ohio. And we are seeing the results, everyone, because I told you in the beginning of the video that I was going to reveal to you all the next city that I think is going to crash. And I'm actually standing on the edge of that city right now. And what I'm talking about is Orlando, Florida. I'm here in Orlando.
Well, I have to laugh because I actually lived in Orlando for about 8 years or so. I lived in different areas. I lived up in Lake Mary, Longwood, Altamont Springs area, and I lived down in the Kissimmee and Lake Nona area. And I personally do love Orlando quite a bit, especially like Winter Park, Windermere area, and it's actually a nice city, a nice place to be. But yeah, as in 2006, 2007, and so on, it just prices just have gone up so bad over the last 4 or 5 years, it just doesn't make any sense.
Orlando, actually in a city called Winter Garden, just on the outskirts of Orlando. And this is an area where not only are the prices starting to drop, the inventory is shooting through the roof. And a lot of people thought that Orlando wasn't going to get hit in this downturn. I saw it in the comment section to my videos. A lot of people said, oh, Nick, it's only the west coast of Florida that's going down. It's only the areas in...
Yeah, no. The main thing is Orlando lives from tourism, especially for Disney and Universal. And I actually worked at Disney for a while. And so if tourism is down because people don't have the money, and international tourism is down because of the uncertainty. As soon as tourism goes down, Orlando will feel the pain, and a lot of people will lose their job or have lost their jobs already, and they might move out because there's nothing else really to work in the Orlando area. So yeah, I can see how that actually will be affected by a downturn pretty badly.
Impacted by the hurricanes? No, no, no. Central Florida is now dropping, and in Orlando especially, everyone, there's now over 14,000 active listings on the market in the metro. You can see that that's the highest level of supply and inventory going back at least 10 years. It's 50% above the long-term norm. So with inventory that high, it's of course leading to a slowdown in the market, and now officially home values in Orlando are dropping down 2.6% year over year. And of course, the investors are a major reason why. The investors invaded Orlando in other parts of Florida during the pandemic. You could see the big spike in investor purchases and now the big collapse.
Well, even though I said, investors should be kind of penalized when they sell too soon, but when you look at the numbers he just showed, it was like 4,000 houses a year that they bought. To be honest, there's so many houses, I think 4,000, that's just a small percentage. That might be 5-6% of the overall market. And I'm not sure if that really has a huge effect on the overall housing market in Orlando or in Florida in general. So could be, but couldn't. I personally think the bigger effect is like Airbnb, stuff like that. Because if there's no tourists, these houses are empty. And those owners, they need to sell those houses at some point, otherwise they are losing a lot of money with that. So yeah, we'll see what else he has to say.
Investor purchases. And so that's leaving a demand vacuum in the market because the locals here in and around Orlando don't have the income to support the current home prices. I mean, the prices here went up like...
Yep, that is true. The local income in Florida in general is quite low. And in the Orlando area, especially with all the service jobs, it's mainly like, hospitality, working in hotels and in theme parks and stuff like that. Those jobs are paid, really bad, to be honest. If they're making like $1,800, $2,000 a month, maybe, then they're good. Other than that, they cannot live in these areas any longer. It's impossible. They have to share rooms and houses with other people. Otherwise, it's impossible to survive.
60-65% in 5 years. They're only down a couple percent from peak. And later in this video, I'm going to reveal to you just how bad I think it's going to get here, as well as some other cities that I think this downturn is going to spread to in the next couple months. But first, we got to talk about some major real estate impacts coming from the recent bill that Congress just passed and that Donald Trump signed into law. Trump's big, beautiful bill has some major implications for the U.S. housing market, particularly related to its handling of what's called the SALT deduction, the SALT cap or SALT deduction. This SALT deduction could potentially flip certain housing markets on their head over the next year. And I'm going to break this down for you all because I think you guys need to stay on top of what's going on here with the tax legislation. This is going to have big impacts on the real estate market. And the SALT deduction, everyone, it's pretty simple. It basically says how much you can reduce your income tax liability by what you pay for property taxes. And prior to this bill being signed, you were capped at $10,000 max deducting your property tax bill on your income taxes. So like, say you had some house with a $30,000 tax bill or a $20,000 tax bill, you could only write off $10,000 of that on your income taxes. Well, now the SALT cap has been raised to $40,000, which means a lot more homeowners are now able to claim bigger income tax deductions from their property tax bill. And what this is ultimately going to do, everyone, is it's going to make home buying more attractive than it was in high property.
I'm pretty sure we have to look more closely into that because I looked into all the other tax deductions that were introduced with the big beautiful bill, like the taxes on tips and taxes that you can deduct when you buy a new car. At the end, it was actually only, you might be able to save another $500, $600, $700, even though it says theoretically you can save $5,000 or $10,000 or whatever in certain cases. It all depends on what your overall salary is, what your overall tax rate is, and so on. So it's not, or it might not, as said, I have not looked into it, but it might not just be, okay, now you can deduct 40,000 flat out. It might depend on what you actually, in what tax bracket you are. So it might only be 40,000 if you're like in the highest tax bracket. So you must make like over 200,000-300,000 a year that you're in that tax bracket. If you're in just like making 60,000-70,000, you might not get the full 40,000. It might only be 10 or 20,000 or something like that. I don't know. I'm just saying you have to look into this more deeply before just believing, oh yeah, now I can deduct 40,000. Nice.
Property tax states. States like New York, Illinois, Connecticut, and New Jersey, as well as even Texas, have very high property taxes, and some people who buy nicer homes in those areas for maybe $1 million or even $800,000 or $1.2 million, they are now going to be able to write off more on their taxes. So I think we're going to see an incremental home buyer demand increase in high property tax states as a result of the SALT cap going from 10,000 to 4,000 in the big beautiful bill. What this also means is that we might see reduced migration out of those high property tax states. So a lot of people might have moved from New York to Florida or New York to Georgia or Tennessee as a way to save on their home ownership costs. Well, now they can
I'm not sure if people actually move on the home ownership cost, if that's the main reason. I personally don't think so. I actually like Florida because of the warm weather. I just like warm weather. So that for me is like the main reason. I don't really care about if there's a tax difference or if there's like no state tax and whatnot, those type of things. That's not the reason for me to move. There might be people that take that as the reason to move, but it's not for me. But I'm not sure if the property tax actually would be a reason to move to another place. Could be, but I'm not sure about that. So that's up for debate.
Actually save just by staying there, since they can deduct a higher portion of their homeowner expenses on their property tax bill. And of course, I already talked to you guys a lot about the bifurcated nature of this housing market. You know, home prices are going down in Florida, where I am right now. They're going down in Texas. They're going down now in Georgia. They're going down in North Carolina. They're going down in Arizona. But they were still going up in New York, Massachusetts, and Connecticut. Well, I just think that trend is going to continue based on the passing of this increase in the SALT cap. It's going to just accentuate the existing trends that were already happening in the market. Maybe parts of Texas get a little bit of a benefit, particularly more expensive parts of Texas, since the property taxes are high there. But overall, it's going to mean more demand in the Northeast and Midwest. It's going to mean, I think, incrementally lower demand in the South, which is great news if you're a prospective home buyer in the South. I know most of you watching my channel, you're either in the South or you're on the Western region of the US. Only about 15 to 20% of you are in the Midwest and Northeast. So I think most of you hearing this news, you're going to actually like hearing it because it means maybe home prices are going to get cheaper in your area. And what's striking to me right now is how this housing market downturn is now spreading. Right? It started in Florida, it started in Texas, but now it's hitting all these other states in the South and West. We're seeing home values now drop in over 30 states on a month-over-month basis. And so this is no longer just a Texas and Florida situation. You should be paying attention if you're a home buyer in these other states, because the inventory is really starting to build. I just pulled some data from the Realtor.com, everyone, and I broke out their inventory by census region, Northeast, Midwest, South, and West. And what we can see here on this map is that in the South, inventory is at 588,000 homes. That's the highest level in Realtor.com's data set. So we literally have a record number of listings in the South. Meanwhile, on the West Coast of America...
What I find interesting about these numbers, though, is just about a year ago, or maybe still right now, the overall statement was, oh, we have a housing shortage. There's not enough houses. We need more houses. And all of a sudden, there's like 600,000 houses available just in the southern part of the US. So if you take all the houses available, you have easily like 1 million houses available right now. And those are just the ones that are actually actively listed. I'm pretty sure there might be another 1 million just hanging around that have not been listed yet, or that people say, oh, we just want to wait, or that are have been originally used for Airbnb, but they're not used right now, and they're just waiting to see what's going to happen. So I don't think there really is a housing shortage. I think it's kind of fabricated just to get more people to buy houses, more or less as an investment tool. And at some point, like in 2008, it will just break down. It's like a house of cards. It will just break down. There's no other way around it.
America, including the Mountain West and California, listings are also at a record. They're around 250,000. So in the South and West, inventory is up about 6% from pre-pandemic norms, while in the Northeast and Midwest, folks, inventory is down 35 to 45% still. Oh my goodness. There's still a massive inventory shortage in the Northeast and Midwest, meaning it's really hard to buy a home in those markets, meaning that prices are still going up. And I think some other cities, folks, that are going to be in the crosshairs, experiencing now what Orlando is experiencing in the next couple months, is going to be Atlanta, is going to be Charlotte, is going to be Raleigh. I mean, home values are already starting to drop in some of these areas by a little bit. In parts of Atlanta, home values are collapsing depending on the neighborhood you're in, particularly on the south side. So we are, really starting to see this spread. I'm actually going to be going to some of these cities on my road trip here over the next couple of weeks. And make sure to actually leave a comment below suggesting what cities you think I should go to on this road trip to do on-the-ground housing market reporting. But one thing I want to be clear about, everyone, is that, when I say, oh, Atlanta's going down or Charlotte's going down or Orlando's going down, I don't mean that every area in these metros is going down, because there's still a lot of local variation. Real estate is really local, and there's some really interesting local trends that are starting to show up across these different housing markets that I want to tell you guys about so you can be more informed about what's going on in your market. And one of these local trends is just very consistent across different cities in the US, that lower income areas with lower college education rates and higher poverty rates, they are going down more. If you were to focus here in Orlando, where are the prices dropping most? It's towards the center of Orlando in the...
It's actually pretty funny because this area around here, Pine Hills, they actually call it Crime Hills because it is pretty much like a crime-ridden area. At least it was, let's say 10 years or so ago or 20 years ago. This was a crime-ridden area, and that's why they call it Crime Hills instead of Pine Hills. So yeah, I can see that house prices go down faster in those areas since they're not really that desirable. So I think that's happening in any city. The non-desirable areas will be the first ones prices go down since not a lot of people want to move there at all.
Low income areas where the median income is 40 to 50,000. Prices are down 6-7% year over year. Whereas in the more affluent areas, such as Windermere or Winter Park, home values are flat to only down by a little bit. In some areas, home values are actually still up year over year that have higher incomes, higher education rates. And so that's the general trend that's fairly consistent whether you're in Orlando, Atlanta, Nashville, Dallas, or Phoenix. There's more stability showing up in higher income neighborhoods, more instability showing up in lower income neighborhoods. And I actually think the investors are a primary reason why. Because when the investors buy homes, and when they bought homes during the pandemic, they really focused actually on buying in lower income neighborhoods with cheaper home prices where they could more easily turn those houses into rentals. And so when I say investor purchases in Orlando are down 60%, what I'm really saying is that in certain neighborhoods, the investor purchases are down 60%. Meanwhile, in a nicer neighborhood like where I am right now in Winter Garden, the investors were never as prominent in this neighborhood, so their 60% decline in purchases isn't having as big of an impact on the housing market in this neighborhood, and there's also fewer investors selling. So the ultimate way I think about it, and I want you guys to think about it, is higher income neighborhoods with higher home prices simply means less investor exposure. And that's why those areas are withstanding the downturn better so far. But you have to wonder, how long is that gonna last, kind of the overperformance of the higher income areas? Because, here where I'm standing right now in Winter Garden, which again, folks, we're about 25-30 minutes to the northwest of Orlando. This is a wealthier suburb, a nicer area. If you buy some of these houses listed at 650 grand or 750 grand, your mortgage payment, according to Zillow, is gonna be $6,000-7,000 a month. Absolutely crazy how much these mortgage payments are getting in some of these wealthier neighborhoods, especially in the South. I mean, these were neighborhoods 5 years ago where you could buy a house with a mortgage payment maybe of $2,500 a month. Now it's $5,000, $6,000, $7,000 a month. So I just wonder, how deep is the marginal buyer pool for these nicer areas in the south that have...
Well, funny that actually is not really that nice of an area. It looks okay. There's nothing wrong with it, but it's kind of older houses. It's kind of, not as nice. There are areas like Winter Park and Windermere, Heathrow, Alakwa Lakes, Lake Nona, and so on that are way nicer than this. And there always have been houses that were like $1 million plus. And I always wondered, to be honest, why and how can they afford all these houses? Because as said, the main jobs in that area is service jobs. So not a lot of people have a lot of money. So it's kind of interesting how this actually works, that there are so many houses in the $1 million plus price range that people can afford. To me, it never really made sense in the first place. Not 10 years ago, not 20 years ago, and especially not now. But somehow it works still, but we'll see how long.
Become like really nice neighborhoods in the last 5 years. Just how big is the buyer pool for these neighborhoods where the mortgage payments are really getting high? Here in this metro in Orlando, the median income is $80,000. Here, the median income is over $100,000. But to afford a house with a $6,000 a month mortgage payment, you need to make probably $250,000, $300,000 a year.
And don't forget the property tax. But the bigger part is actually the homeowners insurance. Because Florida, we know there's hurricanes, and even in Orlando, you're not safe from that. So the homeowners insurance is ludicrously high. So if the mortgage payment is like $6,000, then property tax is another maybe $1,800 or something like that, and then the homeowners insurance might be another $2,000, and most of the places there are HOA, so there's another $400 or so for HOA. So you're looking easily like at $10,000, $12,000 a month fixed cost just to have the house. And then obviously, because it is Florida, it's very humid, you have a lot of time where you have to repair the house constantly on a yearly basis. So it is quite expensive having a house in Florida. So yeah, you need $200,000-$300,000 a year in order to live there in a normal area, which I don't see that actually happening.
I just wonder how many people locally here earn that much money. The economy here in Orlando is really heavily based on the service industry and the entertainment industry. Disney, of course, is here. There's a lot of conferences here. There's some real estate here. But there aren't a lot of $300,000 jobs in Orlando when the nicer neighborhoods are priced where you need to make $300,000. And so I do wonder how sustainable that is, even though the nicer neighborhoods are performing better so far.
Yeah, it wasn't sustainable 2006, 2008, and it's not sustainable now. It will break down. There's no way around it. That's just how economics work. And we will see prices going down, not as much as maybe in the 2008 crash, but I would say at least like between 20 and 40%, I would say would be kind of normal. Otherwise, it just doesn't make sense. People cannot afford it, especially not in Florida.
I also wonder about Orlando's economy overall, everyone, because I was going through some data on airport statistics, and this is something I'm going to talk to you guys more about in the future. We're actually thinking of adding some of this data on airport statistics to Reventure app in the future, looking at how many passengers are getting off the plane in different airports as somewhat of an indicator of the health of the local economy. And here in Orlando International, passenger traffic is down 6% over the last 12 months. That's one of the biggest drops of any large airport in America. Most other airports are either flat or slightly up on passenger traffic. MCO, Orlando International, is down 6%, suggesting fewer tourists coming to Disney, suggesting fewer people visiting, which I think is starting to show up in the local housing market. There's a lot of Airbnb investors here. There's a lot of short-term rental investors here. And any type of decreased demand is going to negatively impact their rental performance. And I think we could also just be seeing a lot of those investors sell, which is why inventory is going up so much. And overall, data from AirDNA shows that there's around 46,000 short-term rental units on the market in the Orlando metro. 46,000 housing units on the market for short.
So yeah, that's what I said before. So you have a huge amount of these Airbnbs, and if they're not filled up, if people lose money with those, they will start selling these houses. There's no other way around it, because it will be way too expensive for them to just have the house not earning any money. So overall, there will be way more houses on the market in the future than there's now. And we don't see that anytime soon the tourism market will actually improve. It might actually still go further down, especially international tourists not coming anymore, or way less. So it will have a big effect on the housing market, especially in the Orlando area.
Short-term rent, Airbnb, Vrbo. Just for perspective, that's about 6.5% of the entire owned housing stock in Orlando. So that's huge exposure to short-term rentals. Again, I don't think that exposure is as big here in a neighborhood like Winter Garden, but overall, the Metro has huge exposure to short-term rentals. So any downturn in the short-term rental market, any kind of mini recession that Orlando experiences due to decreased tourism, which might already be happening due to the airport statistics, that's going to show up in the local housing market, and I believe it's already showing up in the local housing market. And so if you're a home buyer or an investor or a seller right now, there's only one thing you can really do to help yourself make a better decision about when and where to buy, and that's to look at the data.
So yeah, this was a great video and very informative. As said, I lived in Orlando for quite a while. I know the area pretty well. I wanted to buy a house there, and I might actually still in the future buy a house there. Maybe in 3-4 years there's a buyer's market on a bigger scale with lower prices, way lower prices than now. So we'll see about that. But I think he's pretty much spot on that there is a lot of problems in that housing market right now, and we'll see where it's heading. I think a big problem is a lot of those people invested in those houses in the hopes that the prices will always go up. And all of a sudden they're like, oh shit, prices are not going up anymore, and they're kind of stuck, and they just hope that they're not losing as much. So they're not willing yet to really lower the prices as much as they have to. So we'll see how that works out in the future. But it's a very interesting topic, and we'll see how it goes. So yeah, that's it for today's video, and I'll talk to you and see you again in the near future. All right. Thank you. Bye.